Welcome and thank you for standing by. At this time, all participants are in a listen-only mode. Throughout the duration of today's conference, today's call is being recorded. Any objections, you may disconnect at this time. Now I'd like to turn over the conference to Ben Bosco at the FDIC.
Thank you. Good afternoon, everyone, and thank you for joining us for today's webinar. My name is Ben Bosco, and I work in the Division of Risk Management Supervision's Capital Markets Branch. Over the course of the next hour, I, along with my colleague Suzanne Clare, will provide an overview of the recently finalized Community Bank Leverage Ratio Framework. This is the second banker webinar the FDIC has hosted on the CBLR. On November 21st, 2019, our staff participated in an interagency presentation for supervised institutions. As we are quickly approaching the first opt-in date, we wanted to provide an update on the rule for qualifying institutions that may be considering electing the CBLR. So now on to slide 1, where we'll discuss the objectives for today's presentation. So today we want to emphasize the qualifying criteria, discuss the ease of electing the CBLR framework, and also describe how the CBLR works. Finally, we will answer some of the questions emailed prior to or during the presentation after going through the slides. You can submit questions about the information we're presenting by emailing them to rac@fdic.gov or rac@fdic.gov. Today's presentation and a recording of this teleconference will subsequently be made available on www.fdic.gov on the regulatory capital page. We hope to have the presentation up later today, but the actual recording of the webinar will take a little additional time. And now turning to slide 2. The interagency final rule that we are discussing today amends the agency's regulatory capital rule to provide for a simple measure of capital adequacy for certain community banking organizations in accordance with Section 201 of the Economic Growth, Regulatory Relief, and Consumer Protection Act. The final rule was approved by all 3 federal banking agencies and published in the Federal Register on November 13, 2019. The Community Bank Leverage Ratio Framework, or the CBLR framework, is optional for institutions that qualify. The March 31st, 2020 call report is the initial opportunity to elect into the framework. Qualifying institutions can elect at any quarter end after that date as well.
On slide 3, we present a few of the key aspects of the final rule. Let's start with a reminder that the Community Bank Leverage Ratio Framework is an optional, simple leverage capital measure which is generally calculated the same as the generally applicable capital rules leverage ratio. Electing institutions can suspend risk weighting and risk-based capital computations under Part 324, which is the FDIC's capital regs, as long as they remain eligible for the CBLR. For prompt corrective action, or PCA purposes, institutions meeting all qualifying criteria are considered to meet the well-capitalized ratio requirements under the Prompt Corrective Action Framework and the generally applicable capital rule. For an institution to be able to opt in and begin using the CBLR, it must meet the following criteria: having less than $10 billion in total consolidated assets, having a leverage ratio greater than 9%, and meeting the framework's other qualifying criteria. Also included in the final rule is a grace period for electing institution whose leverage ratio falls to 9% or less or falls out of compliance with one of the other qualifying criteria, such as having off-balance sheet exposures of greater than 25% of total assets. Such an institution can remain in the CBLR and be considered to have met the well-capitalized ratio requirements for a grace period of up to 2 quarters. By the end of the 2-quarter grace period, the institution must satisfy all of the qualifying criteria in order to remain in the CBLR. If the institution does not satisfy all of the qualifying criteria by the end of the 2-quarter grace period, then it must revert back to the generally applicable capital rule, including the risk-based capital requirements. Note that there is no grace period for institutions with a CBLR of 8% or less, as the final rule automatically removes those institutions from the framework. These institutions can reinstate the CBLR framework once their CBLR is above 9%, assuming all other qualifying criteria are met. On slide 4, we illustrate the calculation of the CBLR, which is Tier 1 capital, including changes related to the simplifications rule and CECL, is divided by average total assets less any adjustments that were made to Tier 1 capital. The CBLR is generally calculated in the same manner as the leverage ratio is currently calculated in the generally applicable capital rule and is therefore based on Tier 1 capital and average total consolidated assets. The reason for the caveat generally calculated is because under the generally applicable capital rule, if an institution is required to make a deduction from Tier 2 capital and the bank does not have sufficient Tier 2 capital to absorb that deduction, the excess amount is deducted from Tier 1 capital. Under the CBLR, an institution does not calculate Tier 2 capital and does not identify any Tier 2 deductions. So moving to slide 5, we'll discuss the requirements a banking organization must meet in order to be eligible to use the CBLR framework. In order to elect the CBLR framework, a qualifying community banking organization must meet several requirements. An insured depository institution or depository institution holding company cannot be an advanced approaches banking organization or a subsidiary of an advanced approaches banking organization. The banking organization must have total consolidated assets less than $10 billion. The banking organization must report a leverage ratio greater than 9%. The sum of the organization's total off-balance sheet exposures must be 25% or less of its total consolidated assets. We will go through this requirement in more detail on the following slide. Finally, the organization's trading assets plus trading liabilities must be 5% or less of its total consolidated assets.
So on to slide 6, which is going to cover the qualifying criteria with off-balance sheet exposures. So for banks with off-balance sheet activities, the sum of these items is limited to 25% or less of total consolidated assets in order to qualify to use the CBLR framework. These activities include unused commitments, except for unconditionally cancelable commitments, self-liquidating trade-related contingent items that arise from the movement of goods, transaction-related contingent items, sold credit protection through guarantees and credit derivatives, credit-enhancing representations and warranties, securities lent and borrowed, off-balance sheet securitization exposures, financial standby letters of credit, and forward agreements that are not derivative contracts. So we've received lots of questions about the off-balance sheet qualifying criteria. So what we thought would be helpful is to walk through the call report instructions that are currently posted on the FDIC website to calculate the off-balance sheet criteria. Note that the CBLR calculation and the qualifying criteria will be included in an updated Schedule RCR. And again, you can see the complete instructions, including the updated form, on the FDIC website. So in general, the off-balance sheet exposure amount is composed of items that receive capital charges under the risk-based capital ratios. And as you'll see in the following slides, much of this information required is already captured in existing call report line items. So in line 34A, institutions would report the amount of unused conditionally cancelable commitments. In general, this item would include the unused portion of commitments reported in Schedule RCL Item 1 that are not unconditionally cancelable. The reason for that is because under the risk-based capital ratios, unconditionally cancelable commitments do not receive a capital charge and so are not included in the off-balance sheet exposure qualifying criteria in the CBLR. Then in line 34B, institutions should report the sum of securities lent and borrowed from Schedule RCL, Item 6A, and securities borrowed from Schedule RCL, Item 6B. Now in slide 8, we're going to go through the off-balance sheet exposure amounts captured in line 34C, again on the updated Schedule RCR. So in line 34C, institutions should report the sum of the following items: financial standby letters of credit, as reported in Schedule RCL Item 2, transaction-related contingent items, including performance bonds, bid bonds, warranties, and performance standby letters of credit. Performance standby letters of credit are reported in Schedule RCL Item 3. Self-liquidating trade-related contingent items that arise from the movement of goods. These items are reported in Schedule RCL Item 4, which is titled Commercial and Similar Letters of Credit. Sold credit protection in the form of guarantees and credit derivatives. This item does not neatly tie to core report line items included in other schedules, but it is important to note that institutions should not include non-credit derivatives such as FX swaps and interest rate swaps. Continuing on to slide 9, again, these are going to be amounts that are reported in line item 34C. Credit enhancing reps and warranties. So as described in the core report instructions, institutions should refer to the definition of credit enhancing representations and warranties as defined in the capital rule in our Part 324.2 for what exposures to report for this line item. Also report forward agreements that are not derivative contracts. Institutions should include the notional amount of forward agreements as defined in the capital rule. Again, to the extent the forward agreement is a derivative, it would not be included in the off-balance sheet qualifying criteria. Okay, on to slide 10. Off-balance sheet securitizations. This is again is included in line 34C. So here, institutions should include the notional amount of off-balance sheet items that qualify as securitization exposures as defined in the capital rule. Now, in line item 34D, it's the sum of the total off-balance sheet exposures, which would then be compared against the 25% threshold. Hopefully that was helpful. Again, these few slides walk through exactly what the core report instructions say, and those instructions and the form are found on the FFIEC website.
Okay, now moving to slide 11. This slide shows the qualifying criteria for trading assets and trading liabilities that we referenced earlier. If you have any trading assets or trading liabilities, the sum of these items is limited to 5% or less of total consolidated assets. The amounts used in the calculation are the amounts as of the end of the most recent calendar quarter. Slide 12 reflects the banks that are potentially eligible for the election of the CBLR. To illustrate the potential impact on reporting, again, these slides show an estimate of insured depository institutions that could potentially elect the CBLR framework as of the end of 2019. There were over 4,300 institutions that could potentially be eligible to use the framework, and of the 868 institutions that are not eligible, 474 of those are close, with leverage ratios between 8 and 9%. Slide 13 shows how an institution would opt in and out of the framework in a little bit more detail. Institutions meeting the qualifying criteria can opt into the framework by completing the appropriate line items and making required elections on their call report and or Form FRY9C as applicable. Similarly, to opt out of the framework, a qualifying institution can revert to the generally applicable capital rule by completing applicable line items on the call report and or Form FRY9C. Between reporting periods, institutions can also opt out of the CBLR framework by providing risk-based capital ratios under the generally applicable capital rule to their appropriate regulators at the time. After a banking organization opts out of the CBLR framework, it can subsequently opt back in through the call report if it meets the qualifying criteria. Once re-election is made through the call report, the institution can suspend calculation of risk-based capital requirements and other calculations associated with the general applicable capital rule. This slide here shows that the new report, the call report line item, where each bank can elect the CBLR election. I'm sorry. You would just simply insert a 1 if you're electing the CBLR and a 0 if you're not.
Thanks, Susie. Now I'm going to go into a little more detail on what the call report form is going to look like. So slide 15 shows what the new CBLR portion of Schedule RCR will look like. So on this amended Schedule RCR, the CBLR portion will come after the calculation and reporting of Tier 1 capital, which I'm sure you all are familiar with. So the first box, it illustrates the calculation requirements for total assets as used in the leverage ratio calculation. Note that it starts with the average total assets number, and then it's adjusted for amounts deducted from Tier 1 capital. And then the last item in this box is the actual leverage ratio calculation. The second box relates to the qualifying criteria for institutions using the CBLR framework. So here you'll actually see that line 30, you'll see line 31A that Susie just referred to, where the bank indicates either it's 1 or it's 0 election to indicate whether or not it's going to opt into the CBLR framework. And then what you'll see is the rest of the qualifying criteria, which we had covered in previous slides. And then the last box on this slide, you'll see there's additional information that we're going to be collecting from banks that elect the CBLR, which includes impacts from CECL, and also includes other information that we thought was important from a supervisory perspective that we would no longer be collecting because a bank that opts into the CBLR is not going to be calculating risk-based capital ratios, and unconditionally cancelable commitments and investments in Tier 2 capital are items we would be capturing as part of risk-based capital calculations.
Thanks, Ben. So to recap, the final rule, together with associated changes to reporting requirements, will simplify regulatory capital requirements, thus providing regulatory relief to community banking organizations that opt into the CBLR framework. Reduced reporting requirements for the call report that apply to CBLR banks are posted on the FDIC website as Ben referenced and available for all banks to review. Institutions that elect and qualify for the CBLR do not need to calculate high volatility commercial real estate requirements as part of their risk weighting process requirements or apply higher risk weights for mortgage servicing assets, deferred tax assets, or investments in unconsolidated financial institutions. And the next slide, let's talk about some of the things that we're doing at FDIC to get ready for CBLR implementation. FDIC has a number of initiatives underway. We have been conducting the banker outreach, including hosting webinars like today's event, and issuing the Interagency Community Bank Guide, which is on the FDIC website. We've also been educating our examiners about the CBLR. This is a new framework which is designed to be simple, but it is a change from the risk-based capital standard. Therefore, we want to make sure that bankers and examiners have the information available to ensure smooth implementation. FDIC has also worked with the other agencies on a continuous basis on a number of initiatives, including changing the call reports for the CBLR as well as other new capital rules like capital simplifications and the CECL transition rule. We regularly coordinate with the other agencies on questions and webinars about CBLR and other regulatory issues. FDIC is also in the process of updating its report of examination and the risk management manual of examination policies to reflect not only the new CBLR framework, but other capital rules as mentioned. Our aim with the report of examination is to keep the changes simple. So the final slide just offers some resources with some links, and again, these should be posted on our website. And again, this is gives you the links to the bank guide, the rules and regs and various other helpful links. And if you have questions today, you can email rac@fdic.gov, that's RAC@fdic.gov, or we have this regulatory capital inbox at FDIC that comes directly to capital markets that we can handle questions there also. I believe we can take questions now. We have a number of questions that we received earlier and a couple that were left over from the, not left over, but that we had received on the industry or the interagency call in November where we weren't able to address them on the line. So with that, I'll turn it back over to Ben.
Thanks, Susie. So one of the questions is, if capital surplus and retained earnings are less than 9%, but with 100% of the allowance for loan and lease losses, it would be 9%. Does the bank meet the 9% CBLR ratio? So the answer to that is no. So the CBLR, and the reason is, so the CBLR leverage ratio is calculated the same way as the current Tier 1 leverage ratio, and the existing calculation of Tier 1 does not include the allowance for loan and lease losses. Therefore, also under the CBLR, you would not be able to include any portion of the allowance for loan and lease losses. We also received another question. So are Federal Home Loan Bank, or FHLB, letters of credit counted in the off-balance sheet exposures calculation? So the answer to that is no. Letters of credit extended by the FHLB and provided to the bank are not included in the off-balance sheet criterion of the CBLR. In general, the off-balance sheet criterion captures off-balance sheet exposures that are multiplied by a positive credit conversion factor under the generally applicable rule and included in risk-weighted assets. Letters of credit from the FHLB are not included in the risk-based capital calculations because when a bank draws on an FHLB letter of credit that is provided to the bank, a liability is created, which in this case does not require risk weighting. Another question that we received is, how is a liability for a credit enhancement obligation under the FHLB Mortgage Partnership Finance Program, or the MPF program, reflected under the CBLR framework? The answer is that if the credit enhancement meets the definition of a credit-enhancing representation and warranty, or would otherwise be considered an off-balance sheet securitization under the generally applicable rule, the exposure amount would be included in the off-balance sheet criterion. For example, some FHLB programs limit the amount of the bank's credit enhancement obligation. If this is the case, only the exposure amount of the remaining credit enhancement obligation would be included in the off-balance sheet criterion. If the warranty is not limited, then the entire exposure amount would be included in the off-balance sheet criterion.
We've also received a number of questions about how CRE and other loan concentrations will be calculated under the CBLR framework. The agencies recognize that for institutions that choose the CBLR option, there will be an impact on certain asset concentration calculations in the absence of total capital, obviously. And we're discussing with the other agencies how to address to ensure consistency across all institutions. Included in those discussions is a desire to minimize any potential regulatory burden that could arise if electing banking organizations subsequently decide to switch between the CBLR framework and the generally applicable capital rule. So these conversations are ongoing, and we're striving to get more clarity to the industry in the very near term. We've also received a question, what if a bank is a subsidiary of a holding company that has less than $10 billion in total assets? The bank also has less than $10 billion in assets. This situation assumes that the holding company is not an advanced approaches banking organization and that neither is the bank. As long as all the other qualifying criteria are met along with the CBLR requirement, both would qualify for an opt-in election into the CBLR framework. And a related question to that previous one is, what if there are two banks that are subsidiaries of a holding company that has more than $10 billion in total assets but is not an advanced approaches holding company? If each of the subsidiary banks has less than $10 billion in total assets, each could qualify for the CBLR framework. The holdco, though, can't elect the framework and has to do the risk-based capital and under the generally applicable capital rules because it has more than $10 billion in total assets.
I have one other previously received question before we go into the questions that were that are being submitted as we're speaking, actually. So the question is, how does the simplifications capital final rule affect CBLR banks? Banking organizations electing to use the CBLR framework would incorporate the changes made by the capital simplifications final rule when calculating Tier 1 capital, which include an increase in the individual regulatory limit, threshold deduction limit for mortgage servicing assets and certain deferred tax assets from 10% to 25% of a non-advanced purchase banking organization's common equity Tier 1 capital. In addition, the capital simplifications final rule removed the aggregate 15% common equity Tier 1 capital threshold deduction. It streamlined the treatment for investments in the capital of unconsolidated financial institutions, and it simplified the calculation for minority interest limitations for non-advanced purchase banking organizations. So these rules apply whether you're on the CBLR framework or you're on the risk-based framework. And as we had said as part of the presentation, the Tier 1 calculations are similar apart from the potential effect of Tier 2 deductions, which for CBLR Bank you're not required to calculate Tier 2 or identify any Tier 2 deductions. So one of the questions is if a bank opts out, are there any changes to the way a bank calculates their capital ratios? So I think as we were trying to say as part of the presentation, so in the CBLR we use, the community bank leverage ratio itself is the Tier 1 leverage ratio. So you're going to be calculating your common equity Tier 1 capital and then the additional Tier 1 capital. Those two elements combined give you your Tier 1, which is going to be similar to the same, it's the same Tier 1 capital that you have under your risk-based rule as under the CBLR. But if you're a CBLR bank, you can stop at Tier 1, whereas if you are a non-CBLR bank, so a bank that wants to continue to use the risk-based framework, you would then have to calculate Tier 2. You have to calculate your total capital ratio. And obviously you then have to calculate all your risk-weighted assets to calculate all your risk-weighted capital ratios. So I guess there's not really a difference between the two Tier 1s, but if you're a CBLR bank, you could stop at Tier 1, whereas if you want to continue to use the risk-based capital framework, obviously you have to then calculate all the different all the requirements that the risk-based requirement imposes on banking organizations. So we received another question. So what this question says is, what effect does following the CBLR framework have on a banking institution which meets all the eligibility criteria? The loans that are designated as HVCRE or HVADC loans, with HVCRE or HVADC loans still need to be disclosed in the core report, assuming the bank is designated as a well-capitalized bank. So if you're on the CBLR framework, you do not have to calculate risk-weighted assets, and therefore you would not, for your regulatory capital purposes, you're not going to have to identify which loans are HVCRE, because the only reason under the capital rules you identify HVCRE loans is to identify which loans would get a heightened 150% risk weight and which loans could get and which HVADC or HVCRE loans could get a 100% risk weight. So There is no risk weighting under the CBLR framework. That is one of the simplifications that a banking organization can enjoy as part of the CBLR framework. Therefore, for capital purposes, you're not going to have to identify what of your ADC portfolio is HV-CRE or HV-ADC. Although obviously, to the extent that you have to report what portion of your portfolio is a construction loan or an ADC loan, and I know that within Schedule RCC in the core report, there are requirements to identify, to report your construction loans. Obviously, those reporting requirements exist. But from a capital perspective, a bank on the CBLR that obviously meets all the eligibility criteria and that elects to use the CBLR is not going to have to identify any HV-CRE loans. So then we've gotten some questions about where are the slides. So if the slides should be posted today. The recording of this webinar will take a little additional time, but the slides should be posted today, and it can be found on the, if you go to the FDIC website and you can search for regulatory capital, the regulatory capital webpage, you'll be able to identify or find the regulatory capital webpage. You go to that link, and then you should immediately see the slides for this presentation. Again, I hope to have it up later today.
There's a question, does the opt-in or opt-out decision need to be in our policy? There's no requirement for that. The bank's, policy or strategic plan include, you can reference it, but there's no requirement that you elect so in the policy.
Another question that we received today deals with how are financial assets sold with recourse treated with respect to the 25% off balance sheet exposure. So the answer to that, a bank should look to the capital rules definition of a credit enhancing rep and warranty. So if you sold a financial asset with recourse and that transaction meets the definition of a credit enhancing representation or warranty in the capital rule, then you would have to include the total amount of that exposure amount in the off balance sheet qualifying criteria exposure amount. But I'd like to note, if you look at the definition, there are exclusions from what is considered a credit enhancing representation and warranty. So what I'm going to read now comes from the capital rule, and what I'm reading now are exposures that are not considered credit enhancing representation warranties. So if there are early default clauses and similar warranties that permit the return of or premium refund clauses covering 1 to 4 family residential first mortgage loans that qualify for a 50% risk weight for a period not to exceed 120 days from the date of transfer, these warranties may cover only those loans that originated within 1 year of the date of transfer. We have premium refund clauses that cover assets guaranteed in whole or in part by the U.S. government or a U.S. government agency or a GSC, provided the premium refund clauses are for a period not to exceed 120 days from the date of transfer, or warranties that permit the return of underlying exposures in instances of misrepresentation, fraud, or incomplete documentation. So what I just read are these are things that are not considered credit enhancing reps and warranties. and therefore they should not be included in the 25% off-balance sheet exposure qualifying criterion. But again, you should read the definition of credit enhancement and warranty, which is contained in the capital rule. And if it meets that definition but not one of these exclusions, then it would have to be included in the off-balance sheet criteria.
We're on a pause trying to sift through and see if there's other questions. And what we may do is close out and we can get back with the questions. We'll get back directly to the institutions that ask questions, if we can. I just want to wrap it. What was that?
Yeah, so a question that we get sometimes, which is just difficult for us to answer, is, kind of go to the pros and cons or advantages or disadvantages of opting into the CBLR. So I guess the agencies implemented the CBLR following Section 201, or consistent with Section 201 of the Economic Growth, Regulatory Relief, and Consumer Protection Act. So Congress passed a law, and that directed us to write a rule to implement the CBLR into our capital regs, and that is what the agencies did. And it is an optional framework for banks to opt into if they meet all the qualifying criteria. And if you do that, we try to set up the framework so that it's a simpler way to calculate your regulatory capital ratio requirements, right? So under the CBLR, you don't calculate risk-weighted assets. So RCR Part 2, where you have all your HVCRE loans and retail exposures and corporate exposures, and you're not going to have to fill it out. You don't have to risk weight. You just have your Tier 1 capital calculation, which you have all calculated for a while, over average assets, and you have a single ratio, as opposed to having multiple ratios, like a common equity Tier 1 risk-based capital ratio, a Tier 1 capital ratio, a total capital ratio, plus a Tier 1 ratio. So we set it out as a simpler framework, and it's really up to the bank based upon their own facts and circumstances. It's up to your board, your management, what you think is the what you think is the most appropriate way, is the most appropriate way forward for your bank. We're not really in a position to say. We didn't set one framework out to be better or worse than the other, or one to be viewed as disadvantaging or advantaging you. It's really an optional framework that allows a bank to calculate their capital requirement in a much simpler fashion. That was the intention. That's what we try to set out to do. And every institution, we encourage every institution to read the rule, understand it, ask us questions, and if you think it's appropriate, then you should use it. But of course, it's optional, and if you don't want to use it, you can also continue to do the risk-based capital requirements.
We got a question if there's is it possible to get the responses in written form. So when they, what we'll do is we'll post the script, but it takes time to have the recording transcribed, and then we clean that, and we have to have the webinar recording and the script all accessible. So we will get that, and I believe we will be able to have the script, included with the other links to materials on our web page. So with that, I think we'll just close out today's webinar, and I want to thank everybody for their time this afternoon, and the operator for facilitating for us, and Ben for being the fearless leader of the webinar today. So thank you, everyone.
Thank you for your participation in today's conference. Please disconnect at this time.